The final payment for provisional tax is on the 7th of May 2025, and businesses all over the country have been busy working out whether they need to pay this or not, or maybe the accountant has been doing it for them, because we certainly have for different clients. And Phil, we're going to go through some insights of what we've been seeing when it comes to the 2025 financial year profitability.
Mate, I am fired up and excited as always. Anything tax related, and mate, I'm there. And I can tell by your intro, you're absolutely pumped up.
I'm jazzed.
Yeah.
Actually, to be fair to the tax world, these are often the most popular podcasts. I think people like to get insights as to,
No way.
Yeah, prov tax and who's paying what in different industries. So
Yeah, the old comparison piece there.
Yeah, let's get into it.
So I guess for a bit of background context to everyone that's tuning in, what we do with all of our clients is review our list and go, what does the IRD expect everyone to pay? And then compare that to what their P&L is actually saying to go, are you paying the right amount, too much, too little, to ultimately avoid that surprise when the tax return ultimately gets filed? Because there's nothing worse than getting your tax return and then seeing that you've got $30,000 to pay and it's sitting in the driveway as a Ford Ranger.
Oh, not the Ranger.
And then regretting the decision because you've spent your tax money and you haven't been told about it. So we like to prevent that. And after we've gone through that process, which we've already done with all of our clients, there's themes that evolve. And we've had a bit of a chat about it, and there seems to be a bit of a common theme by the time we've got to the end of March 2025. And from my point of view, it would look like if people are paying on what IRD say they have to pay as the standard option, they'll be overpaying.
So for some context for those people new to the tax world, the standard option is based on the year before. So this payment at the 7th of May is the third instalment. So we have the 28th of August, the 15th of January, and then the 7th of May. And it's based on normally a 5% uplift on the year's profitability from the year before. So say you made $100,000 in 2024 financial year, ended 31 March 2024, then they'd expect that you're going to make the same profit in the 2025 financial year ending 31st of March 2025, plus another 5%. So they would be saying, well, we want you to be paying tax based on the 100 grand plus another 5%. So their thinking being that everybody becomes more profitable each year, and that by the time you do your accounts after the financial year, that hopefully there's not too much of a discrepancy between what you have paid and what you actually needed to pay based on the accurate financial data. But that's an old methodology given what happened to the world of accounting, i.e. real-time data.
Yeah.
So in April, we can just about work out with live data from the likes of Xero and MYOB what the profitability was through to 31st of March 2024, 5, 26, etc. So by the 7th of May, we kind of know to have pretty good accuracy what the tax position would be.
Yeah, we've got a rough idea, and I think using that P&L from 31 March, and I'd take a punt and say your average accountant has got an above average degree of intelligence and would be able to look at the profit and go, I know that I need to adjust this for depreciation and home office or the other non-taxable bits and pieces, and then estimate what the likely taxable profit will be. If we know what the taxable profit is, we know what the tax rate is, one multiplied by the other, hey presto, this is how much tax you've got to pay, and this is how much you've paid throughout the year. You've either got a little bit more to pay or you've paid way too much. And then when you start talking to the clients and saying, oh, hey, look, IRD is saying that you've got to pay $20,000, based on what we're saying, you don't need to pay anything at all because you've already paid enough. If you pay the $20,000, you're ultimately going to get that refunded. Do you want IRD to hold on to your money between now and when your tax return's finally done to get it refunded? And most people that you speak to will be like, no, I want to keep that money in my bank account because I've got better things to do with it than leave it in the government's bank
Coffers.
account. Yeah.
Yeah. And Nicola, what you talking about? Willis might spend it in the meantime buying you Navy frigate.
Yeah, good luck to her on that one. Yeah. But it's been really interesting and to see that obviously if you're using the standard option, that there's the standard uplift of 5%, which implies that everything grows from year to year. And if we're saying to clients, hey, look, you don't need to pay as much, profits across the board are indicatively lower. And that broadly ties in with what we've been talking about for the last God knows how long, and all the data to support it, that the reality of 2025 is now coming to fruition with actual year-end accounting report data that it has been tougher than the year before. And people are having to pay less tax. And it's really important to actually make sure that we go through and do this so that we're not tying, like as I said before, tying up cash unnecessarily over to the IRD.
I think to highlight this as an example, with one of the clients that I worked through their provisional tax, their profit was that much lower that they do not need to make a payment at all at P3. So they've paid enough at August and January to cover the eventual profits in their business. However, the IRD still expect them and are still sending them a message saying, you owe us tax on the 7th of May because it's based on the year before. The IRD do not have the data yet to know that they actually weren't that profitable. So I get in, do some calcs, make sure it's all accurate and say, are you guys happy with this? Are you sure there's nothing missing? Yep. Okay, based on that, you do not need to make that payment at May. Otherwise, all that's going to happen is that we're going to file the accounts. The IRD are then going to get the data and go, oh, you paid too much tax, we'll give you that money back.
On the flip side, there's one that I looked at, and it's a relatively new client to us. And I said, hey, look, it's time for provisional tax, and this is the way we do it. And introduce them to our style, because we know that it's not what other accountants typically do. And they got the email, digested it and replied, and basically said, if I could paraphrase and recall what he said was, thanks so much. I really appreciate the insights and how you've outlined this with the options that I've got. And in their particular case, it was the other side, that they've made significantly more income than they did in 2024 to what they've got in 2025. And the tax on that income is astronomically higher.
Yeah.
And their accountant in the past has told them to pay based on the standard option. And this client had said to me, the accountant had been in touch and said, hey, you need to pay this because it's what IRD expect. And being the smart people that we are, it's like, well, actually, by the time this all comes out, you're going to end up needing to pay tens of thousands of dollars more. And they had the tax set aside in a separate tax savings account. Tick number one. I don't know if they listen to the podcast or not, but really smart that they know that some of the money that they're receiving, the tax man's going to want a bite of the cherry. So we come along and email and say, well, look, yes, you've got to pay less than $10,000 at this installment, but by the time it's all washed up, there's a catch-up of tens of thousands of dollars. His reply back to me, not only being grateful, was just like, okay, now that I understand the options, I've got a decision of either going, I can pay the IRD now and be done with it and know that it's, yep, cool, just do the paperwork side of things and there might be a small wash-up. Or, this is what I found really fascinating, was, okay, so I can now get that money and try and beat the return of what the cost of the interest is. So their tax for the year is over $60,000, so they're exposed to interest costs. And we know that interest is about 9%, I think. I can't remember what the latest use of money rates are.
Yeah.
But let's say 9%. And he's basically like, right, between now and when the tax ultimately needs to pay, I need to get a better than 9% return. And I was just like, wow, there's some next level thinking.
So they're either buying Bitcoin or Auckland property. Which did they say? Or?
I haven't heard yet. I was going to wait till next week and just say, hey, mate, you're going to have a consider. Really curious to understand, like, are you going black? Are you going red? Is this Bitcoin? You know, have you got a horse in some race that we don't know about? Like,
we
what's
want to know.
Yeah. And then we'll get the we'll get the oil on that transaction. And if there's something that we could potentially have a punt on, then we might dial in and just piggyback and see if we can get the same returns.
I think you mentioned something important which we'll unpack, and that's they've got more than $60,000 tax to pay. So there's an ugly tax rule. The way that I explain it to businesses, especially if they're getting started, is basically once you have over $60,000 worth of tax to pay, you're in another set of tax rules. And basically, and this isn't exactly right, so those in the big towers with the big brands and whatnot, the franchise owners or workers at the franchise accounting places will be like, he didn't explain this. This is to help educate people. So I say you're in a different set of rules. And so basically, you now need to pay all of that by the 7th of May. Otherwise, you're going to pay interest on that. And I had a client where they're only into year 2, and that's exactly what they've got. And I said, geez, mate, I didn't even really realize you were going to be that profitable. Like, are you sure that your zero is accurate? They're like, yeah. I'm like, oh, mate, you're now in these set of rules. You need to pay all of that by the 7th of May. Otherwise, you're going to have interest to pay on the shortfall. Because the way I explain it is like the IRD think that you, at that level of profit and therefore tax to pay, have a level of sophistication that you should know how much tax you should have to pay, and they want you to pay it so that they get their pound of flesh. Whereas for another client who doesn't have that level of tax to pay, but they still have more to pay, I've said to them, for them, you can pay your 7th of May obligation based on 2024, but 2025 you're more profitable, so you're going to have a shortfall of tax. You can either pay that in May to just be ahead of it and be done with it, or it's going to be due in the 7th of April 2026.
Yeah.
And they've chosen to pay it in April 2026.
And that's because their tax is under 60,000, so there's no use of money interest.
Yes.
But it is more than the standard option. So the thing that you've done is educate them on the gap between the standard option and their estimated tax.
Yeah.
And then go, you need to make sure that you've got this pot of cash ready come the 7th of April. And if you don't come crying to us because we told you so.
Exactly, education number 2 piece there, because it's then what I say is, just a heads up, just about 80% of people that we see pay the terminal tax the whole year later hate it. So you have to understand that your emotion on the 7th of April 2026 is going to be, F-bomb, I don't want to pay this tax, but you're going to have to.
Yeah,
and you've made the decision now.
It's amazing how much of a grudge it is, like that almost 12 months later, that it's like parting ways with the tax, and it's almost like another, again, told you so, we had the discussions, you should have paid it, then you wouldn't be having these feelings now of wanting to let go of the cash because it's been sitting there for so long. You get attached to it and think, I could do this with it, I could do that with it, and then finally it's gone. It's like, now I can't do anything with it.
Some of them I say, why not set up an automatic payment? So let's say you've got 10 grand that's going to be owing us terminal tax in April 2026. I'm like, just pay $1,000 a month. You've got 10 months. And I would say 90% of the time I don't see an AP get set up.
Yeah, I would say probably 99% of the time, I can't think of a single time somebody's ever set up an automatic payment.
And I wonder what that is, but I assume that it's like, nah, that's April next year, that's ages away. I'll worry about that next month. Out of mind, then you're paying GST, you're paying the other taxes, you completely forget about it, then the months keep rolling by all of a sudden. Hey, and how many times have we seen we get to March, and say, hey, remember you've got terminal tax in April. Oh shit, what's that for again? Or, hey, any of those options about not paying that?
Hey, and of all the emails that we send and we say, hey, look, cash flow plan for this and put a calendar reminder, how many people do you think actually put the calendar reminder in?
The really diligent clients. I know a number of them will be watching, so we're not throwing you under the bus right now, but some of them, it's like, come on, guys, but I get it, you think, I'll worry about paying that. It's just any sort of household bill, you think, I'm going to wait till the due date to pay that. And we just build that behavior into business.
Totally.
But man, it can suck letting go of 3 grand, 4 grand, 10 grand, 20 grand.
Coming back to the other rules that you spoke about, where if your tax for the year is over $60,000, the different set of rules apply. So that's then if your tax is over that amount, you're charged interest on the shortfall or the underpaid tax. So the difference between what you had to pay on the standard option and what your actual tax turns out to be. So, for example, if your actual tax was $100,000 and you were required to pay $70,000 as the minimum, the gap's 30. You're going to be charged interest on the 30 from the provisional tax last date, which is the 7th of May, until you actually pay that terminal tax. So it could be any time between 7th of May and ultimately the 7th of April. Now, the thing that still fascinates me the most is that people go penalty interest. Oh, interest penalty. And they think that IRD interest is a penalty, that you're being charged for something that you shouldn't be doing. And I think there's a big education piece there for business owners or anyone that's getting charged IRD interest. It's just the way the rules work. I don't know where they came up with $60,000. It'll be somebody in a suit or some fancy dress or pants down in Wellington with a computer and some glasses going, let's pick a number. Hands up for 60,000. And they probably go, yep, most hands in the room, let's go with that. That's arbitrarily the number. And above that, you get charged interest. It's just a cost of capital. And you could go and get the money from your overdraft or your mortgage, and bear in mind the IRD interest rate is 9%, and it's still interest, so it's an expense, it's not a penalty, so it's going to come off your profit anyway next time we do your tax calculation. You could go and get that money at a cheaper rate. So if you don't want to pay IRD interest at 9%, go and find the money somewhere else at a lower interest rate. But I think it's a really important point that it's an expense, not a penalty.
Yeah. The $60,000 rule probably doesn't apply. It probably applies to about 2% of taxpayers because I think it's taxed on about $200K if that's through the PAYE system, which I think is a likelihood of 2% in New Zealand that you earn that. Through a company, probably, even more again because you're going to get capped at 28. But yeah, it's just one of those things to keep in mind because it can catch people out. But for a lot of people, they don't need to worry about it. But I think you highlight a good bit there around there's a difference between late payment penalties from the IRD, which aren't tax deductible and are effectively like a fine.
They are, yeah. Like your car parking tickets.
About to say that, yeah. Or driving in a...
Thanks, Auckland Transport.
There's busy lane that they have and there's never anyone in them.
It's because they're not busy, eh?
Yeah, they're not busy. You can go straight
You're trying to make them
lane.
busy, but...
Yeah, and you pay to go in them and you get this fine that turns up in the busy lane, yeah. So those are not tax deductible. And the interest on the debt is. So this client who I said, look, you've got to have paid, let's say it's like 70 grand by 7th of May to make sure you've paid all of your tax. I said your tax is above 60K. You're going to get charged interest if you don't. I said you could maybe pay 50 if you don't have the whole lot, but you're going to get charged on the shortfall. But it is tax deductible. So I tried to educate them on the whole thing so that they could make the decision what is it that they want to do. Because they might even want to look at like using that money to buy a book if they're in, say, the mortgage space, for instance, or that sort of, buying something or investing
also not Jacinda Ardern's latest book.
Not that one.
You're like an income-generating asset book
yes.
that they could create income into the future from.
Yeah, that would be more expensive, that investment, I would say.
Yeah, probably.
So then they can effectively use that tax money as a finance option in their business and then incur the cost. But as soon as they get to 7th of April 2026, if they hadn't paid it, then they would get a late payment penalty because that's actually when it's due, but the interest accrues from 7th of May. Is that correct?
Yeah, sounds about right.
Yeah, okay.
Yeah, it's all kiddie. I think the main thing that this discussion really highlights is that when it comes to provisional tax, there are a lot of options.
There are.
And at the end of the day, it comes down to cash flow planning. And there's no one-size-fits-all approach to everyone. And it really highlights the importance of having the right relationship with your accountant, that you can talk to them, they understand you, you understand them, and you do what's right for you. And, if you're at the bar talking to your other mates that are in business, sinking a few cans, and if they're doing something and you're doing something different, it doesn't mean that anyone's wrong. It's just you're doing what's right for you.
Now, I kept a spreadsheet, mate, of just about every single provisional tax payment, and therefore quiet couple of words as note, knowing that we might do this podcast. So I could skim through over 60 of them very, very quickly. But some themes that I saw, like I've got, well, one thing I noticed that clients that have done 90-day business planning with us or some form of advisory work and are on the growth trajectory, a lot of them actually have more tax to pay. So their installments at May aren't enough.
Nice.
And they're either going to pay voluntary or they're going to pay terminal tax. Whereas I think the more established businesses that have been going a bit longer and are kind of like in the trenches are either paying the standard obligation, but looks like it's slightly overpaying, and they're probably going to end up with a small refund, or they're paying a bit less.
Yeah.
Yeah. So those are probably my two clear themes, which I just thought it's always fascinating with the different types of industries and whatnot, how some of these businesses are actually going and how different it is to the narrative of the media, but also the type of people running these businesses and when you get to know them and their mindsets and just sort of the way they operate, their tax bill and their profit often lines up.
Correlation.
Yeah. Which is fascinating.
So really what that's saying to me is that anyone that's tuning into this episode, having just heard that, if they want to be paying more tax because they want more profit, is get in touch with us.
100%.
LNP at nextadvisory.nz will help unlock the answers for you.
Simple as that, mate.
Hey, mate, I went, I appreciate we've been going full noise, but we love a tax pod. My mind immediately went into nerd mode and bust out the old crystal balls, gave them a polish, and then go, well, if this is what's happened for 2025, we're paying less, what's going to happen in 2026? Because the first installment is in August, and that's going to come around real quick. This stuff just always does. And my mind immediately went to, if the economy is going to recover to the extent that everyone would have you believe it would, if people pay on the standard option of 2025, which in some cases is a significant reduction on what 2024 was, then the likelihood of having a tax surprise in 2026, because it's based off of 2025, increases a lot more. So as business owners work through this new financial year, it's going to be really important for them to monitor their P&L and compare it to how it's gone for the same period last year, 2025, and go, am I doing better or worse? We'd want to hope it's better because there's all this positive noise about things happening out there. And if it is better, just because the cash is in the bank account, don't go and spend it, it's going to be tax. And when you get your tax notice from your accountant that says, oh, you've only got to pay $5,000 and you've still got cash left over, that's because you're not paying enough, because the standard option hasn't kept up with the changes in your business and the changes in the economy as we move through 2026.
Yeah, it's a good point, mate. And I think a lot of people won't actually have their accounts done by August because it takes time. And like the IRD, for instance, wrote to all accountants and said, we don't want you filing anything until late May.
Week.
Yeah, Kiwi saver data and all
We're
sorts
ready to file.
Yeah, let's go. So there's a risk as well that people are told by their accountants in August what their tax obligation is based on 2024 because they haven't done 2025 yet. And then basically the way that it works is the IRD will then just say, well, pay based on 5% higher, 10% higher than 2024, right?
Yep.
But if you know, and you're watching this and you go, well, actually, I know my 2025 was shit hot or it was shit cold and a lot different to 2024, you need to let your accountant know. Hopefully, well, you're not going to see this before 7th of May, I doubt, but let them know before the 28th of August as well, because you don't want to be paying tax on the 28th of August that's based on 2 years ago, effectively, the 2024 financial year, where that's completely different to the trading environment that you're in and that you have been in since March 2024.
And a comment that you made there, which further, I think, compounds it, is unfortunately, a lot of businesses don't know how they're going because they don't dedicate the time to read their P&Ls and actually understand. And then go, oh, gee, how is this actually tracking? What are the trends? What's the data saying? What are the decisions I need to make? What are the insights here that are going to create issues into the future that I need to be taking action on now? I mean, that's a topic for a whole nother discussion, but as we've always said in the past, create calendar minders, review your numbers, understand your P&L.
Yeah, and I mean, like two good examples where this will help people understand is we've got clients who have stock, right? So we can't just look at their zero and go, oh, they're profitable. We need to know, well, hang on, how much of your purchases are stock? Because we've then got to back the stock out. So if you have a stock business, you need to invest some time into understanding how profit works in a stock business. We have businesses who rent things out, and so a lot of their money is tied up in the assets that they rent out. So they'll have high levels of income. If the depreciation isn't run for that client in zero, which
way overstating the profit.
Yeah, and I've seen one of those businesses recently where depreciation's not run. I'm like, you need to be running this monthly, and that's just part of what you need to do in your business because that's what is going on. But this is another reminder too. Any major financial transaction or event that happens throughout the financial year, let your accountant know, because we've got a very proactive client, and they told us about how one of their vehicles was stolen. So then we need to account for that and look at, okay, what's the insurance? Well, there's a chance for them that they might not actually get insurance. So then we've got to look at, okay, what's the treatment of that? We might be able to write the entire vehicle off. That's actually really impacted what their profit is because of the depreciation and the loss on sale of that effectively. And therefore, they don't need to pay at installment 3. Now, if we don't know that information, we just look at it and go, oh, yeah, Xero says things are hunky-dory.
Yeah.
Actually, their worlds fall into shit behind the bloody email. I'm like, oh, guys, let's have a chat about this and look at some options.
Spot on, mate. I was on a call earlier this week with a client, and they gave me some news about something they were up to, just casually dropped it into the convo, and I just said to them, guys, when were you going to talk to me about this? Because this is a major change in your business, and there's going to be tax impacts on this.
Yeah.
Because it involves moving into Australia.
Oh, yeah, just casually.
Just casually moving into Australia. So tell me more about that. And I was just like, okay, right. Send me an email, let's pick this up, and we'll do it properly. But you're spot on, and I wish that more people had better relationships with their accountants where they could feel that they could let them know or involve them in their businesses as they go throughout the year not have to worry about, oh, I'm going to get a fee from bloody Charlie the calculator crusher every month.
Charlie.
Every month just because I've sent in an email because I want them to know that I bought an asset or I've sold this or I'm thinking about doing that, because it's all data points that are important for an accountant to help manage your taxes so that you're in the best position possible for managing your cash and not getting a surprise.
Yeah, I don't know how many times we have to restate it, but if you're buying assets, if you're selling assets, if something's been stolen, if you're writing something off, if someone's not going to pay. I looked at a business the other day and they've got hundreds of thousands of dollars outstanding, and some of the debtors go back ages. So again, like when we're doing provisional tax, like, are you going to get paid those? Because you know, the level that they're at, they're in the top tax bracket. So for every $10,000 of invoices that actually need to be written off to bad debts, there's $4,000 of tax, or $3,900 that they don't need to be paying. But if we're just looking at it going, oh, yep, they're flying, but really, oh, we come to do the accounts, oh, bad debt, bad debt, bad debt. So we're having those conversations faster. So I think the way that tax works in the country of provisional tax hasn't really kept up with the technology that's been inserted, which is great. It gives us an advantage because we get to give more proactive advice, and more people get tax surprises and they want to change their accountants. So a reminder, if you get a tax surprise, then you need to jump on the website, we'll retarget you until eventually you switch to Next Advisory.
Hey, cop that. LNP at nextadvisory.nz or book a Calendly link.
Anything that we've missed, mate?
I was going to say, I think that's a pretty good wrap-up of a topic that can be somewhat complex and overwhelming for people that are probably new to the game, or it's another reminder or refresher for business owners that get back into business as usual trenches and then have to bring themselves back out, because this is stuff that's working on the business. Of going, hey, I need to look big picture, how am I going? And depending on how I'm going is going to impact tax, which impacts cash flow. Yeah, if none of this makes sense to you, my final two things would be, if you're making more money than you were the year before, that should be a red flag to remind yourself you need to start asking about this stuff and ask your accountant to get them to explain it in your words and based on your business. And if you're making a lot less money than you have in prior years, tell your accountant as well. And we've had clients do both of those. And the good thing is, once they let us know, we can dig into it, we can give them good advice. If your accountant doesn't know, they're too busy filling out their timesheet, not working on a Friday in the Waikato, all sorts. Who knows what they're up to, mate? Yeah, the luxuries, mate. I mean, there's a lifestyle that we would aspire to maybe one day unlock, maybe not, because we love what we do so much that it extends to Saturdays and Sundays.
For sure, it certainly can. Right, well, hopefully you've learned something there. We're trying to educate people all the time about provisional tax. And like Phil said before, if you do need a hand, jump on the website. You can book a time to have a chat. And we'll see you in the next episode where we bring even more education to you aspirational business owners.